Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into Copart Inc., CPRT, the Junkyard Dog Compounder.
And we have a fascinating and I think a highly contentious thesis to unpack for you today.
Let's hear it.
Copart operates as a structural oligopoly in vehicle remarketing, betting that its record FY 2025 financial results and nearly insurmountable dual competitive moats, that's physical land and digital liquidity, guarantee the persistence of high returns for decades, justifying a premium valuation against the long-term AV disruption risk and the immediate DOJ money laundering investigation.
Wow, okay. That thesis really sets the stage. It's a classic debate, isn't it? You have this unparalleled quality on one side versus a price that, might make you wince a little on the other.
Exactly.
So our mission in this deep dive is to synthesize the critical data points that either validate this premium valuation or maybe reveal some cracks in that foundation. We aren't just looking for growth.
No, not at all.
We're investigating the specific structural and even cultural advantages that allow Copart to continuously compound capital at such an elite level. Specifically, we're drilling down on how a business that, let's be honest, deals with wrecked cars.
Right.
Manages to maintain an average return on invested capital, an ROIC, of around 25% since 2016.
And that sustained performance in such a physically demanding industry, it just warrants a really rigorous examination.
It does. That 25% ROIC figure is really the entire starting point for the investment case, isn't it?
It has to be. It signals that this isn't some commodity business. It's a structural advantage, just, masquerading as a salvage operation.
A very effective masquerade.
It is. If you can reinvest every dollar of profit and reliably generate 25 cents back on that dollar year after year, your long-term returns they're inevitably going to be enormous. So our job is to understand exactly how they pull that off in a field that seems, on the surface, entirely mundane.
Okay, let's ground this structural analysis immediately in the latest data. We need to see if the machine is still humming. And the fiscal year 2025 results, which just wrapped up on July 31st, they seem to suggest it's operating at peak performance.
Oh, absolutely. The headline numbers, they confirm that robust compounding trajectory. It silences any of those recent whispers you might have heard about market saturation.
So what are the numbers?
The results are really a declaration of strength. For the year ended July 31st, 2025, total revenue hit $4.65 billion.
Okay.
That represents a really robust 9.7% year-over-year growth.
And in an industry facing, all kinds of macroeconomic headwinds, maintaining near double-digit growth like that, it demonstrates some serious pricing power and inelastic demand.
It does. And crucially, the profitability didn't just keep pace. It actually showed significant acceleration. And that's what separates the true quality compounders from just simple revenue growers.
Right. So where did the income land?
GAAP Operating Income rose to $1.7 billion. That's a solid 8% increase. But look at the bottom line. This is where it gets interesting.
The EPS.
The diluted earnings per share. The figure that directly impacts you, the shareholder. It was $1.59, showing an even greater acceleration with a 13.6% year-over-year increase.
Okay, so that difference, that gap between 9.7% revenue growth and 13.6% EPS growth, that's the operational leverage you're always looking for.
That's the magic. It confirms the business model is still highly scalable. As revenues climb, the fixed costs of running their digital platform, and even some of the fixed costs of owning the land, they get spread over a larger base of vehicles and fees.
Which leads to margin expansion and faster EPS growth. It really suggests that the cost structure is incredibly optimized.
It is.
So that brings us to the quality of that revenue. When we say $4.65 billion, we're not talking about a traditional retailer, are we? This isn't a capital-intensive resale model.
Not at all. And this is probably the single most important detail about Copart's high ROIC. Their main income stream is service revenue.
So fees.
All fees. Auction fees, storage fees, related processing charges. This service revenue accounted for roughly 85% of their total revenue in FY 2025.
85%.
Yep, totaling $3.97 billion. And that's why we can confidently categorize them as an asset-light, high-margin middleman.
That distinction is just paramount. They're not taking principal risk by owning the vast majority of these cars.
No inventory risk.
They are the facilitator, the sophisticated platform, collecting fees from the insurance companies for getting them the highest possible price. They're essentially a software and logistics company wrapped in a junkyard uniform.
That's a perfect way to put it. They get paid to facilitate a transaction, which means their capital isn't tied up in inventory that could depreciate. And if we look beyond the U.S., The expansion signals this high-margin model is globally deployable.
So it travels well.
Extremely well. International service revenue growth was particularly strong. It accelerated at an 18.9% clip. That tells you that new facilities opening in the UK, Spain, Brazil, they're scaling quickly and adopting that VB3 digital platform model very effectively.
So that international acceleration is proof that the moat isn't just about U.S. zoning laws, but that the digital framework can be exported globally. Let's shift focus from the income statement to the balance sheet.
Yes.
Because this is where the term fortress truly defines their financial posture. They maintain massive liquidity.
Massive is almost an understatement when you consider the scale versus what they actually need to operate. Copart maintains approximately $6 billion in total liquidity.
$6 billion.
And when you analyze the composition, this includes a whopping $4.8 billion in cash and marketable securities.
$4.8 billion. Okay, in a deep dive focused on capital allocation, we have to ask, what is that money doing? Are they aggressively buying other companies? Are they just sitting on the sidelines?
That is the critical question. And the analysis of their financials shows these funds are not in risky ventures. They are overwhelmingly invested in highly conservative assets,
Like what?
mainly U.S. Treasury bills, classified as held to maturity. This is a deliberate, ultra-conservative decision. And in an environment of higher interest rates, they're benefiting substantially from interest income, which flows right to their bottom line. It's a fantastic low-risk kicker.
So on one hand, this $4.8 billion cash hoard, it signals phenomenal financial discipline. It's protection against any economic shock. But I have to push back a bit.
Go for it.
In an era where every CFO is pressured to either acquire something or return capital to shareholders immediately, doesn't holding $4.8 billion in T-bills signal maybe a lack of high ROIC opportunities? Or is it just pure contrarian discipline?
I think it's pure, uncompromising long-term discipline. They operate under the belief that maintaining optionality is their highest strategic value. They see themselves as the buyer of last resort when the right piece of land becomes available, or when a smaller international competitor is in distress.
And their financing model backs that up.
It absolutely reinforces it. They maintain a definitive zero-debt position. As of July 31, 2025, there were no borrowings under their revolving loan facility.
Which they have, but they don't touch.
Right, and that facility itself offers a $1.25 billion limit. So they have the $6 billion in liquidity and access to another $1.25 billion totally untouched.
So not only are they debt-free, they have immediate access to capital for any strategic purpose without having to go begging to the capital markets. That financial strength means they can execute their land acquisition strategy, which we'll definitely get to at any point in the cycle.
Regardless of market conditions, this self-funded optionality is, as you said, the defining characteristic of a true compounding machine. It is the foundation that lets them ignore short-term market noise and focus purely on strategic high-return investments.
And this strategic patience and financial strength, it leads us directly into the engine room of their competitive advantage. You call it the dual moat.
The dual moat.
So let's dive deep into that. You characterize this as two mutually reinforcing barriers. How do these two moats, one based on, concrete and zoning laws, the other on silicon and network effects, how do they work together?
The dual moat concept is the entire key to their exceptional ROIC. It's the hard physical infrastructure protecting them locally, coupled with the soft, scalable digital network protecting them globally. Most businesses, they only have one or the other.
Right.
Copart has erected two walls that, together, create a highly resilient oligopoly.
Okay, let's start with the hard moat then. The physical infrastructure, or what the industry wryly calls the NIMBY moat. How vast is this physical footprint, and why is owning it so critical?
The physical scale is vast. It's hard to grasp. Copart operates 281 total operating facilities globally.
And these aren't small lots.
No, these are thousands of acres of strategically located land. And crucially, unlike many competitors who lease, Copart has this ownership mindset. They own approximately 90% of their real estate portfolio.
Right.
They treat land as an indispensable strategic asset that appreciates in value and can't be taken away.
No, this ownership mentality seems a little contradictory to the asset-light label we just applied, right? I mean, they spent $500 million on land in 2024. How can we still say the core revenue is asset-light when they're so capital-intensive on the land side?
That's a great point of friction. And the distinction is crucial. The revenue is asset-light based on fees, but the moat is capital-intensive.
Okay, I see.
They use their operating cash flow, that asset-light, high-margin service revenue, to aggressively fund the capital-intensive moat expansion, which is buying land. The land itself is the barrier. not the source of high-margin income.
And this is where the NIMBY barrier, the not in my backyard phenomenon, creates that almost permanent structural advantage.
Exactly. Think about the requirements. A modern salvage yard needs several hundred acres, immediate highway access to keep towing costs down for the insurer, and critically, it needs to be located near large population centers where the accidents actually happen.
And you can't just go get that zone today.
Try getting zoning approval for a massive industrial facility, a junkyard near Dallas or Atlanta or London. It's politically and economically near impossible. The local opposition is fierce.
Because Copart already owns 90% of its land, much of which they bought decades ago before all this scrutiny existed, they're essentially grandfathered into the best, most strategic locations. A new competitor just can't replicate that network.
It makes it a structural oligopoly, cemented by concrete and restrictive zoning laws. That's precisely why the land is indispensable. It's not just land, it's zoned land, ready for specialized use in the perfect logistical location. This physical scarcity ensures their supply chain, the insurance companies, have no viable alternative.
Okay, so that's the hard, physical, slow-moving moat. And now we turn to the second one, the digital moat, built on the VB3 platform. This is the fast, scalable, network effect-driven side of the business.
And this is where Copart really became an innovator, not just a land baron. They pioneered the shift. They became exclusively an online auction platform, VB3, way back in 2003.
2003, that's early.
It was profoundly contrarian at the time. It gave them a massive first-mover advantage in aggregating demand.
But what makes VB3 a true moat? You know, beyond just being an online auction site, there are a million of those.
It's the sheer size and density of the network. It creates a self-reinforcing loop. VB3 leverages technology to connect the consigners, the insurance companies, to a massive buyer base. Over 1 million registered members from 165 different countries.
Wait, 1 million registered members. That number can be misleading. How active is that buyer base, really? Is there a risk that 90% of them are dormant and the real liquidity is just a few hundred bulk buyers?
That's a warranted skepticism. But the evidence of active bidding is right there in the realized prices. The network density ensures superior price discovery, and that's the most critical factor for the insurer.
Because the bidders are global.
Right. The auction isn't constrained by local demand. They're matching a totaled Ford F-150 to the single highest bidder, whether that bidder is a parts dismantler in Texas, a small rebuilder in Germany, or an exporter shipping containers to the Middle East.
And that arbitrage opportunity, the difference in value a part or a chassis holds across continents, that's what fuels this global demand. And the source material highlights just how vital that is. International members account for what? Something like 40% of all vehicles sold at U.S. auctions.
That 40% figure is the proof of the moat's power. It means Copart is consistently delivering prices that competitors who are constrained by regional demand simply cannot match. This allows them to deliver the highest and best use of every vehicle anywhere in the world.
Which locks in the insurance companies.
It locks them in for the long term. Because if they go anywhere else, their net loss per totaled vehicle goes up. The digital moat ensures high prices, and the physical moat ensures the inventory is stored securely and cost-effectively. It's an indispensable value chain lock-in.
That seamless integration is the key. They take a highly localized physical problem, where do I put 50,000 wrecked cars, and solve it with a completely scalable, global, digital solution. Okay, let's pivot to the supply side.
The funnels into the system.
Exactly. The demand for their service relies on a continuous supply of total loss vehicles, and that supply is driven by these powerful secular trends. Let's talk about the total loss frequency, or TLF, acceleration.
TLF is the lifeblood of the business. It's the percentage of collisions that result in the insurer declaring the vehicle a total loss. And this is the primary structural growth driver for their supply. It's been continuously rising for 40 years.
A relentless, long-term trend.
It is. It's based not just on accident volume, but on the economics of repair.
And the current data confirms this trend is accelerating fast enough to feed Copart's growth, right? I think TLF reached 22.2% in Q2 2025.
It did, which is up from 21.5% just a year prior. That half% jump, it represents a huge volume of additional total loss vehicles being funneled into the auction system.
So what's the driver here? Is it just more accidents?
It's simple physics and high technology, vehicle complexity. Every modern safety feature, every infotainment screen, every collision avoidance sensor adds astronomical repair costs when damaged.
So we're in an era where bumper damage isn't just a body shop repair, it's a recalibration project.
That's the specific cost catalyst. Complexity drives repair costs dramatically. The sources note that 31% of direct repair program, or DRP estimates, now require advanced calibrations.
These are the Advanced Driver Assistance Systems, ADS.
Exactly. If a camera sensor mounted behind the rearview mirror is damaged, or if the car's even slightly misaligned, that sensor must be precisely recalibrated using proprietary software and specialized equipment.
So what used to be a $2,000 repair now involves a $5,000 repair plus, $3,000 in recalibration fees. It pushes the cost well past that traditional 70% threshold of the vehicle's pre-accident value.
And boom, it's a total loss declaration. Precisely.
Yeah.
As long as auto manufacturers keep packing more technology into cars, a trend that will not reverse, TLF will continue its inevitable climb, ensuring a stable, growing supply of high-value salvage for Copart.
This inherent structural tailwind also provides the business with a remarkable defense mechanism, the countercyclical hedge. How does Copart manage to stabilize volume even during economic downturns?
It's this really elegant inverse relationship. The decision to total a vehicle is based on two things: cost of repair and pre-accident value. When used car prices fall, the vehicle's pre-accident value drops.
But the repair costs stay high.
They stay fixed or even continue to rise due to parts and labor.
So if a high-tech car was worth $30,000 and repair costs hit $20,000, it might be fixed. But if a used car market downturn drops that car's value to $25,000, that same $20,000 repair now represents 80% of its value.
You hit the nail on the head. That higher proportion means insurers total more vehicles when the used car market is soft. This increase in total loss volume helps stabilize Copart's business when other auto segments might be contracting. It's a natural hedge built right into the insurance economics.
And we've seen this play out before. And despite broader market fluctuations, that global network, that liquidity, helps them maintain pricing power. I think they achieved something like 5.4% average selling price growth in Q4 of 2025.
That ASP growth is a key indicator of the health of the digital moat. Even if domestic buyers are feeling constrained, the global bidding pool, those buyers in 165 countries, ensures the ultimate sale price stays strong. It validates the insurer's decision to total the car in the first place.
And the structural growth isn't limited to gasoline engines. Let's look at the next big shift: electrification, EVs, and their ESG strategy.
Right, electric vehicle adoption is set to amplify the TLF trend significantly. EVs often have higher initial repair costs, especially related to the battery components.
A battery pack is the whole car, basically.
It is. It's not only expensive to replace, but it also involves complex diagnostics and, potential fire risks.
And even a minor undercarriage strike that compromises the battery housing can result in an automatic total loss.
Exactly. As EV adoption accelerates, more of these high-cost components will enter the salvage stream, further increasing TLF. The supply-side tailwind is set to accelerate, not decelerate.
At the same time, the company has wisely aligned itself with the global push for sustainability. They're focused on countering that perception of a junkyard by adopting an ESG narrative around the circular economy.
It's a very shrewd strategic move. By emphasizing their role in the circular economy, reusing parts, recycling raw materials, Copart mitigates potential environmental scrutiny, especially on the land use side.
Do they have numbers on that?
They do. They claim their operations enable the avoidance of more than 12 million metric tons of CO2e in fiscal year 2024 by extending vehicle life and recycling. And they make the point that this number dwarfs the actual emissions from their own business.
So by positioning themselves not as a junkyard, but as essential recycling infrastructure, they're proactively defending that physical moat from regulatory attack. It turns a potential liability into a PR asset.
It speaks to the holistic, long-term thinking of management. And speaking of management, that leads us to the core qualitative advantage of this business: the history, ethos, and capital allocation structure that built this thing.
Right. This story starts with the founder, Willis Johnson, who established Copart back in 1982. The company didn't just build an efficient operation, it built its foundation on radical, long-term trust, especially with its partners, the insurance carriers.
And the defining moment that solidified this trust, the moment that is still referenced in the industry today, was Hurricane Katrina in 2005. This wasn't just a logistical challenge, it was a cultural crucible that demanded a massive financial sacrifice in the short term for long-term loyalty.
Take us through that narrative, because it really demonstrates that founder ethos of playing the infinite game rather than just maximizing the quarter.
So when Katrina hit the Gulf Coast, the scale of the disaster was unprecedented. You had tens of thousands of flooded, totaled vehicles that needed immediate processing and storage. This created a massive strain. Copart's normal operations just couldn't handle it.
They had to improvise.
They had to hire emergency staff,
Hmm.
secure temporary storage sites, use expensive transport. Processing this volume generated huge, unanticipated surge costs.
And the immediate reaction of any transactional vendor would be to pass those costs right on to the clients, the insurance carriers.
Exactly, who were already reeling from billions in claims. But Copart chose the path of radical partnership. Management made the strategic and very costly decision to absorb those massive surge charges and extra operating costs entirely.
Entirely. They didn't pass any of it on.
None of it. They effectively subsidized the insurance industry's recovery efforts.
That must have cost them tens, maybe hundreds of millions in short-term profit.
It did. But by sacrificing those immediate profits, they solidified their reputation as an indispensable, reliable, long-term partner. That decision cemented market share and established trust that competitors just couldn't buy. It transformed them from a salvage provider into an essential part of the insurance industry's catastrophic claims infrastructure.
And that focus on long-term partnership, it really permeates the entire management structure. We see that philosophy reflected in their commitment to owner-operator alignment. Former CEO Jay Adair's tenure is a perfect example of this.
Adair famously led by example for years. He accepted a symbolic $1 annual salary and relied purely on stock-based compensation. His personal net worth was entirely tied to the long-term appreciation of the stock.
Perfect alignment.
Perfect alignment with shareholders. And while Jeff Leah took over as CEO in 2024, that focus on long-term compounding remains absolutely central to their ethos.
The message is clear. Management wins only if the shareholders win, over decades. And this owner-operator mindset is most evident in how they handle their disciplined capital reinvestment. They don't seem to chase fads.
Their number one priority is consistently reinvestment into high ROIC internal projects, specifically land over any kind of financial engineering. That substantial cash hoard we talked about is deliberately managed with strategic patience.
And management has been quoted on this.
Yes. They've stated that the substantial cash pile doesn't cause us to change our behavior.
That's such a powerful statement of discipline. It implies they're resistant to that market pressure to just deploy cash for the sake of it.
Absolutely. They only deploy capital into what they see as high ROIC opportunities, even if it means they sit on the sidelines for a few quarters. The clearest evidence is their land investment strategy.
So just how aggressive are they on the land front?
Very aggressive but disciplined. They invested over $500 million in FY 2024 on land acquisition and development alone. They are voracious, opportunistic buyers focusing on expanding their footprint around key metro areas where that zoning barrier is highest.
Because they know that land bought today, even if it's expensive, will be irreplaceable tomorrow.
Exactly. So they're prioritizing tangible, hard-to-replicate assets over simply inflating short-term EPS with big buybacks. You noted they paused significant share repurchases since 2020. That seems to conflict with what a lot of other cash-generative companies are doing.
It's a direct conflict, and it speaks to their internal confidence. They believe the returns from expanding the physical moat, which has historically yielded 20% or more ROIC, are superior to buying back their own stock at current valuations. Resisting that temptation is a core qualitative advantage.
It really is the essence of compounding. You have to have the confidence that your advantage is enduring enough to warrant investing heavily in the future, even if your balance sheet looks a little inefficient to some short-term analysts.
Which brings us to our final section, the final verdict and structural risks. We've defined Copart as an exceptionally high-quality, structurally dominant business. So given that quality, does the performance justify the premium price?
Historically, yes. The returns have justified almost any entry point. The business model has generated an eye-popping average annual return of about 21.6% over the last 30 years. You are buying a machine that has reliably printed money for decades.
However, based on the FY 2025 results, the stock is currently trading near 28 times diluted EPS of $1.59. That is a premium valuation demanding perfect execution and high growth for years to come.
And the justification for that premium, it really rests on this argument of time horizon arbitrage.
Explain that.
If the dual moats, the specialized land and the global digital liquidity, truly guarantee the persistence of high returns for decades, then that high initial PE multiple becomes less relevant. You're paying up for the rare durability and quality of future cash flows, especially given their self-funded zero-debt growth model.
That logic holds, provided those moats aren't breached by some disruptive technology. So let's confront the primary existential threat, autonomous vehicles, AVs. This is the long-term risk hanging over the entire auto aftermarket industry.
It is. AVs remain the major long-term risk that investors have to weigh. Widespread adoption of Level 4 or Level 5 autonomous vehicles could, theoretically, dramatically cut accident rates,
By 80 or 90%, some futurists predict.
which would choke off Copart's supply of salvage vehicles entirely.
But the reality is that the transition is proving to be excruciatingly slow and highly complex, both technologically and regulatorily.
Correct. Management is keenly aware of this risk, but they remain pragmatic about the timeline. They currently describe the impact of operating AVs, like the Waymo fleets in limited areas, on their auction activity as a de minimis effect.
So basically nothing.
Essentially nothing yet. It means the threat is distant and slow-moving due to the decades-long replacement cycles required to shift the entire global fleet to full autonomy. We're talking about a 20 to 30-year amortization of risk, which gives Copart plenty of time to adapt.
So while the technological change is inevitable, the pace provides a wide margin of safety. Now, we have to address the immediate, high-stakes legal and regulatory issues they face today.
And this is a big one. The key immediate risk is the ongoing DOJ investigation. The U.S. Department of Justice is conducting an investigation into potential violations by the company of certain money laundering laws.
That's a serious threat. It suggests problems with their Know Your Customer, their KYC procedures, related to auction platform members. What's the potential fallout here?
It represents a source of material liability. We're talking potentially substantial fines and significant managerial distraction. The DOJ is looking into how effective Copart's procedures are for preventing money laundering activity by its global auction members.
So even though they're cooperating?
Even though they're cooperating, any failure to effectively monitor their 1 million registered users could result in strict regulatory oversight or, and this is critical, restrict the participation of certain global buyer segments.
Which would directly undermine the liquidity of that VB3 digital moat.
It's a direct threat to the very core of their superior price discovery. If regulatory risk restricts that 40% international buyer pool, the entire thesis weakens.
And on top of that, there's the risk of environmental scrutiny.
Exactly. While Copart pitches its ESG role, stringent land use and environmental laws are a constant friction point. Increased scrutiny could restrict global buyers or, more commonly, just limit the expansion of that vital physical moat, making new land acquisition even more difficult or costly than it already is.
Okay, so to synthesize the entire investment case, Copart is a rare, structurally dominant business with exceptional financial health. It's built on this slow-moving, heavy infrastructure of owned, zoned land and the fast-moving, globally scalable technology of VB3. The valuation hinges entirely on the persistence of that double moat.
Absolutely. The investment thesis relies on the confidence that the core operational model can generate enough cash flow to aggressively outrun the long-term technological disruption from AVs and successfully mitigate the immediate legal and regulatory shadows from the DOJ and environmental pressure.
That leaves us with one highly provocative thought for you to carry forward. Since Copart's superior price discovery and global network effect rely so heavily on that massive international demand, with international buyers purchasing 40% of U.S. vehicles, what happens to their entire pricing advantage if a major global trade conflict or a severe sudden currency shock in one of those 165 countries drastically and rapidly restricts that vital international demand? That's the vulnerability of relying on global arbitrage to maximize domestic asset value.
A critical systemic risk that the internal moats simply cannot guard against.
Risk defined, portfolio protected.